Thank you very much.
Sorry.
Mr. Lankford.
Thank you, Mr. Chairman. Dr. Bernanke, thank you for coming, spending a day. I'm sure it's your favorite day of the week every time that you come up to the Hill and get a chance to spend the morning with us, so thank you for doing this. In Oklahoma, where I represent, there have been a very large number of community banks that I have chatted with that are very frustrated at the regulatory environment that is now coming down. They feel like some of the largest banks in America made some mistakes and they're being punished for it. Lending has slowed down dramatically, and they look at a single element for that. They look at the regulatory environment that is surrounding them. Personal perspective for you. Where do you think the community banks stand as far as in a need to circle around them capital requirements and change some of the rules from discretionary to now that is really what the rule is on areas? How do we free up the flow of money and lending in smaller community banks and rural communities?
Well, first, community banks have really shown their worth in this lending crisis. As many larger banks withdrew from small communities or from small business lending, a lot of community banks stepped up and began to make more loans. And that just shows the value of their personal connections and their knowledge of the local community and so on. I absolutely agree with you that small banks cannot bear the same burden of regulation that the largest banks bear. Certainly they don't pose the same risks to the financial system, for example. Right. So what the Federal Reserve is doing there is several parts. I mean, first, we have added new committees and advisory groups to our regular routine where the board meets with outside committees to create special roles for community banks. So we have a new subcommittee on community banking. We have a council of community bankers that comes 3 times a year to meet with the board and talk about their issues. And we want to make particularly sure that as we implement the Dodd-Frank regulations, for example, which are mostly aimed at large systemically critical banks, that we are very attentive to the possible implications for small banks, and we do want to do that. The other thing that we've tried to do, and this is for all banks, is that we recognize that in some cases after a crisis that bank examiners can become very conservative because they don't want to see their bank fail and be responsible for that. And as a result, they may put pressure on banks not to make what would otherwise be potentially good loans. So we have done all we can to fight against that by issuing guidance to our examiners and to the banks that we want loans to be made to creditworthy borrowers, by training our examiners, by having meetings all across the country with small businesses and small banks. So we're very focused on that issue, and I think we've made some progress. And what I'm hearing and what we're seeing in some surveys is some modest improvement now in terms of the lending environment for smaller business and some growth among community banks.
Well, let me just say to you from the Oklahoma perspective, there's been growth in that area. It's been very modest because there's continued frustration with individuals that are saying, I need to lend, and have plenty of folks that want to be able to borrow, but I'm tapped out in all these areas, and my regulators are telling me this, and I'm stuck. And companies in the local areas are saying, I'd like to borrow, I'd like to expand, I'd like to hire more people, but currently the bank is hiring more compliance officers, and we're doing less lending. And that's a very bad formula for what is actually functional for us.
I agree with you.
Okay, let me mention a couple of things. Right now, you'd mentioned the high priority for you is dealing with unemployment, which is great on that. Then I'm sure there are times in different quarters you deal with inflation. How do you balance out? What formula do you work through to say, I'm going to balance it? This quarter is going to be more on inflation. This quarter is going to be more on unemployment numbers. How do you all make that decision?
We do it based on a variety of models and other things that help us project forward where we think the economy is going to go. And right now, our models are showing that unemployment is likely to stay high for some time, as I was discussing earlier. And inflation, notwithstanding, we know about the commodity price increases. Of course, we're paying close attention to that. But notwithstanding that, underlying inflation looks to be still pretty low. And so based on that, we think accommodative policies are still warranted. Now, we are very committed to price stability. We are not buying into any idea that we can get some more employment by letting inflation get higher than normal. We're not going to do that. Okay. We want inflation to be somewhere around 2% or a bit less. So as our models begin to suggest that the economy is moving towards those desired levels, then, just like a quarterback has to lead a receiver, we have to begin to move before the economy gets there, because we've got to withdraw that stimulus in advance of the point where we get to where we want to be. So even though models and projections and forecasts are obviously not always accurate, they really are our best tool to try to analyze at what point we need to begin to pull back on that support and begin to worry more about the inflation side and less about the employment side.
Okay. Thank you, Mr. Chairman. I yield back.
Mr. Ryan.
Thank you, Chairman Ryan.